Wall Street just told you stocks will crush gold. They are dead wrong, and here is the proof. Two respected voices in this space completely disagree about gold right now. Here is both sides, and you decide. Gold is sitting at $4,452 an ounce today. Not $2,000. Not $3,000. $4,452. And yet Wall Street, with a straight face, is publishing research telling retail investors that the stock market is about to deliver returns well above its long-term average over the next 12 months. They want you to look over there, at the S&P 500, at tech earnings, at AI momentum. Meanwhile, gold has quietly done something that almost no mainstream outlet will say plainly. It has more than doubled in roughly 3 years. From around $1,800 in early 2022 to $4,452 today. That is not a hedge anymore. That is a bull market. So here is the real question, and it is the one you have been asking in the comments, week after week. Where does gold go from here? Do we see $5,000 before the end of 2026, or does this rally run out of road? Two serious, data-driven camps have formed on this. I am going to give you both arguments, as strongly as I can make them. Then I will tell you where I personally land. Let's go. First, the bull case. The case that gold is not just rising, but is repricing permanently, and the people calling for $5,000 and beyond are not being reckless, they are being rational. Start with the federal. The federal funds rate right now is 3.63%. That sounds restrictive, but here is what Wall Street does not advertise. Here is the part that should make you uncomfortable. Real interest rates, meaning the nominal rate minus actual inflation, are barely punishing gold at all right now. CPI is sitting at 332.813 on the index, and the year-over-year pace is still elevated enough that the real return on cash in short bonds is barely positive for most savers. Gold does not pay a yield, yes, but when your alternative is barely keeping pace with inflation, gold's zero yield starts looking pretty competitive. Then look at the GDP number. US real GDP growth is running at just 1.5%. That is not a recession, but it is not prosperity either. It is the kind of slow bleed economy where governments historically spend more, borrow more, and quietly debase their currencies faster than the official numbers admit. The gold bull says, this is the environment gold was literally built for. And here is the structural data point that almost nobody in the mainstream is talking about. Central banks globally have been net buyers of gold for over 15 consecutive years. In 2022 and 2023 combined, central bank gold purchases hit levels not seen since the 1960s. These are not retail investors panic buying. These are institutions with century-long planning horizons quietly rotating out of dollar-denominated reserves and into physical metal. When the institutions that print money start buying the thing that cannot be printed, you should probably pay attention. The bull also points to geopolitics. Middle East supply risks are still live, oil prices are still volatile, and every time a new geopolitical fault line opens up, the question of which assets survive a breakdown comes back to gold. It has survived every empire, every currency collapse, every financial crisis for over 5,000 years. The bull's closing argument is simple. If gold is at $4,452 today with the Fed still holding rates at 3.63%, what happens when the next easing cycle kicks in fully and real rates go negative again? The last time real rates went deeply negative, gold ran from around $1,200 to over $2,000 in about 18 months. The bull says $5,000 is not a prediction, it is arithmetic. Now the bear case. And I want to be clear, this side deserves a genuinely fair hearing, because the people making it are not stupid. The bear starts with valuation and momentum. Gold at $4,452 has already priced in an enormous amount of bad news. The Russia-Ukraine war, the Middle East conflict, the debt ceiling crises, the Fed pivot expectations, the dollar weakness narrative. All of it. The bear asks, what is the incremental catalyst that takes gold another 12% to $5,000 when so much fear is already in the price? Then the bear points to the stock market competition. Wall Street's current argument, even if you are skeptical of it, has real data behind it. If the S&P 500 delivers even 10% to 12% returns over the next 12 months, which is not insane given earnings growth in AI and tech, capital will rotate back toward equities. Money is not loyal. It goes where returns are. And $4,452 gold needs something to go wrong to keep attracting fresh capital at this price. The bear also flags Bitcoin. Crypto is quietly absorbing some of the safe haven demand that used to flow exclusively to gold. Bitcoin edging higher on fading rate rise bets is a real signal that younger capital, the next generation of wealth, is choosing a different store of value. If even 10% to 15% of the demand that would have gone to gold now splits toward Bitcoin, that is a meaningful headwind at the margin. And here is the bear's sharpest point. US real GDP at 1.5% is soft, yes, but it is not collapsing. If the economy stabilizes, if the Fed holds rates steady or even nudges higher, if inflation cools another half a point, the narrative that has driven gold from $1,800 to $4,452 starts to lose its urgency. Markets are forward-looking. They do not wait for the crisis to arrive. They price it in advance. The bear's case is that the crisis is already priced. So where do I personally land? And I want to be clear, this is just my own read, not a call to action for your money. I think the structural bull case is stronger than the cyclical bear case over a 2 to 3 year horizon. Here is why. The central bank buying is not speculative. It is policy. Institutions do not quietly accumulate 15 years of a single asset and then sell it because a quarter of GDP data came in soft. The geopolitical architecture of the world is genuinely fracturing away from dollar hegemony, and gold is the one asset every sovereign on every side of that fracture agrees has value. That is not a trade, that is a restructuring. But I also think the bear is right about one thing: the next 12 months for gold could be volatile and choppy, not linear. We saw gold dip during the Iran crisis earlier this year, which shocked a lot of people watching this channel. That kind of counterintuitive move happens when an asset is already priced for fear. Short-term dips, even sharp ones, are completely consistent with a long-term bull market. The question is not whether gold goes up every month. The question is where it is in 3 years. And on that question, I am still in the bull camp. Here's what I want from you, though. The whole point of laying out both sides is that you think through this yourself. The viewers who comment on this channel consistently have sharper takes than most financial media I read. So I want your genuine view. Where does gold end 2026? Below $4,000, between $4,000 and $5,000, or above $5,000? Drop your honest answer below. Not what you hope, what you actually think. And if you want to keep following the data on this, subscribe to this channel. Every week I go through the macro numbers, the central bank moves, the Fed signals, and the institutional positioning data that the mainstream buries on page 12. You will get the full picture, not the Wall Street summary version. Hit the bell so you don't miss it. Just to be clear, I am not a financial advisor. I am just someone genuinely obsessed with this stuff, doing my own homework and sharing it. Nothing here is personalized advice for your situation. Most people consuming financial content never stop to ask whether the person talking actually has skin in the game or an agenda. Do your own research, talk to people you trust, and stress test every argument you hear, including mine. That is the only honest way to do this.